Hello and welcome to Livewire's Buy, Hold, Sell. My name is Hansley. It has been a very volatile 12 months, least of all I need to tell you that. And because of it, investors have gravitated towards stocks with rock-solid balance sheets. But have some of these stocks also become crowded trades? Let's probe those ideas right now with Andrew McKee from Elson Asset Management and Rob Crookston from Wilsons. First company, Aristocrat Leisure. Andrew reported 27% net profit growth in its most recent earnings result, thanks primarily to its US operation. Is it a buy, hold or sell?
Oh, it's definitely a buy for us. I don't think it's overbought at all. The business has done a great job, management's done a great job over the last few years to increase the amount of recurring revenue coming through, as well as diversify the business in terms of digital. So if we look at the pixel side of the business, obviously there's a bit of COVID flux. Digital did really well during COVID. But we're seeing that now counterbalanced with land sales. You mentioned the US doing quite well. And we think the balance sheet is pristine. We think the margins are great, the cash flow is great. We think they've got optionality in terms of growth, whether they do buybacks or they look at additional acquisitions, particularly in digital. So, we really like the business. We don't think it's overvalued at the moment and definitely a buy for us.
Okay, a buy for Andrew. Rob, all the brokers love this stock. Citi, Morgans, Morgan Stanley, Macquarie, Ord Minnett all have it on outperform or buy. What do you think? Buy, hold or sell?
Yeah, it's a buy for us as well. Think about the land-based gaming, the traditional business. We like that. Greater recurring revenue that has in the past. We like the digital business. We still think there's a lot of growth to come from the digital business over the next 10 years. What we really like is the online real money gaming opportunity for Aristocrat. So if you think of online real money gaming, which is slowly getting legalized in the US, you take the land-based gaming and the mobile gaming, put them together, Aristocrat are really perfectly positioned to go for this opportunity over the next decade. So they've done the acquisition in the last few months of Neo Games. That gives them the tech stack to go after this. And as I said, they've got the IP already. We think to go after this opportunity. Consensus at the moment really has zero embedded in it for online real money gaming. So the opportunity is there. It's not priced in. I don't think it's crowded at 18 times of the opportunities ahead of them. Okay, interesting. So we've got a double buy to start the show. Let's see if we can keep it up with Telstra. UBS recently upgraded this one to a buy, but it is on 22 times earnings. Rob, buy, hold or sell? Yeah, it's a buy for us. What we like, the resilience of the mobile plan business. That's still a massive part of Telstra's business. I think, I can attest that mobile plans for me are a key part of everyone's budgets. They probably didn't used to be 10 years ago even, but they are now. And the other part as well is the industry has also got a lot more rational in terms of pricing. So Optus and Vodafone have got a lot more rational in the way they're pricing. That intense pricing competition we've seen for a long time is now dissipated. So really now Telstra can increase their prices, and they have been over the last 12 months, and they can do that and keep their market share, and that's key. And probably the third point is we're hoping that management over the next couple of years unlock the value of the InfraCo business. At the moment, it looks really undervalued just in the group structure when we do some of the parts analysis on Telstra. So if they can maybe divest some of that like they did the towers business, we think the market then will see the value of InfraCo, and that could re-rate from there. So yeah, buy.
Okay, interesting. Andrew, a lot of people think of Telstra as a great dividend payer. 5 years ago, though, Telstra had an 8% dividend yield. Now it's about 4%. What do you think? Buy, hold or sell?
We're more of a hold on Telstra at the moment. Agree with Rob though. If we decompose Telstra into its predominant EBITDA groups, you're looking at mobiles and you're looking at InfraCo. They're the real drivers of EBITDA. Mobile's very much what Rob says. I can see why people like it. It's defensive. They've got pricing power. People nowadays would probably go without eating rather than go without their mobile phone. So that's clearly a great business longer term. But if we also look at free cash flow, most of that goes into the dividend. If you look at the dividend balance sheet, it's okay. There's not a lot of growth for us going forward. So on a relative growth basis and valuation basis, it's a hold with obviously a dominant market position in mobiles.
All right, well, speaking of eating and drinking, third stock here, Endeavour Group, of course the Woolworths spin-off, down 22% though in the last year. Andrew, is it a buy, hold or sell?
Oh, it's definitely a buy for us, Hans. Clearly not overbought given the 12-month performance. If we look at retail, we love Dan Murphy's. We love BWS and their store rollout in both of those retail businesses. If you look at Dan's, its dominant position, we call it the Bunnings of booze in Australia. We don't see a lot of competition for Dan Murphy's. They're vertically integrating 5.1 million users on the app. So we think that's a great business. Admittedly rolling off a little bit from COVID, but that's counterbalanced with hotels, which is very strong coming out of COVID lockdown. They've got a buying program as well for their pubs, undercapitalised in terms of ownership under Woolworths, so underinvested business, so refurbishment, new pubs, which also then augments their retail strategy in terms of Dan and BWS rollouts as well. So, coming into tougher economic times, we think it's more likely that would play into Endeavour Group's core businesses that people will entertain at home, which is, say, good for Dan Murphy's and BWS. And they're more likely to go out, but maybe dial it back a bit, go to the pub rather than the Michelin star restaurant like you, Hans. So they still want to have fun, but just obviously aware of cost of living pressures there. So that helps Endeavour in our group.
All right, so Endeavour there, a buy. Rob, what do you think about this one, buy, hold or sell?
Yeah, it's a sell for us. And really is, the valuation probably does look better, but we just can't get excited about a business that we think is going to grow at sort of mid-single digits over the next couple of years. So really it's just too low a growth for us to get too excited. I see it maybe as a bit of a value trap at the moment.
Okay, interesting. So we've asked our fund managers as well to bring along one stock that they think has a rock solid balance sheet and is not a crowded trade as of yet. Rob, I'll stay with you. What did you bring us?
Yes, so Hans, the Lottery Corporation is our pick. I think it's got a reasonable balance sheet, gearing still below guided range, resilient cash flows, and really that's driven by the counter-cyclical nature of lottery sales. It's capital light, CapEx is around about 5% of EBITDA, so we like that part of it as well. In terms of earnings, we think there's a good story there from moving from paper tickets to digital, and with that you're getting margin expansion at the same time. So we're thinking here you've got double-digit growth, and for what is a very resilient business.
Okay, so the Lottery Corporation for Rob. Andrew, what's a stock with a rock-solid balance sheet and it's not a crowded trade?
We love Lottery Corporation as well, so I really agree with Rob there. But Nine Entertainment for us is one we think's worth a look. Obviously, from a macro perspective, people are concerned about ad spend, but if you look at the quality of the business since they've merged with Fairfax, those assets are very hard to replicate, not easily, easily to compete with in terms of broadcasting, publishing, Stan, Domain, the radio network. So very dominant position. They've done a great job of also converting to digital. So if we look at subscription, we look at digital advertising revenues, now 50% of overall revenues, a lot more resilient than just ad spend. And so although there's market concern about ad spend, we think that's the opportunity to acquire the stock at the moment. We think that they've got pricing power and subscriptions as well, and that the balance sheet is pristine. So currently buying back 10% of their stock. We see that continuing with free cash flow the next 5 years. Rock solid business for us.
Okay. Andrew and Rob, thank you very much for your insights. And thank you for joining us. If you enjoyed that episode of Buy, Hold, Sell, why not give us a like? And you can subscribe to our YouTube channel as well as both the Livewire and Market Index websites. We'll see you soon for another Buy, Hold, Sell.